There are thousands of trading indicators out there, but very few of them are consistently and similarly used by top traders, banks, and hedge funds around the world. In this video, I'm going to show you 5 of these indicators and explain why and how top traders, hedge funds, and banks utilize them so that you can potentially incorporate them into your trading plan. Additionally, I will reveal the one mistake traders often make that can absolutely devastate their accounts. Now let's delve into the indicators. Number 1. The Bollinger Bands, used by Morgan Stanley, a multinational investment bank. Ray Dalio, a billionaire hedge fund manager and the chief investment officer of one of the largest hedge funds in the world, and also used by Renaissance Technologies, an investment management firm known for its mathematical and statistical methods in investments. They use it to visualize volatility and breakout points, acting as dynamic support and resistance, helping them assess the market's condition and potential movements. The Bollinger Bands consist of a middle band representing the average price, and lastly, the upper and lower bands that dynamically adjust based on price volatility, aiding traders in identifying potential breakout and reversal points. So how do they use it? Before delving into that, let's make things clear. One indicator by itself can't accurately predict whether the market is going up or down. Therefore, it's advisable to use other confluences and confirmations when implementing these concepts. With that said, let's explore how they utilize the Bollinger Bands. The way they use the Bollinger Bands is very straightforward. During an uptrend, they look for the price to touch or slightly penetrate the lower band. This can signal a buying opportunity, suggesting that the price has temporarily moved to the lower end of its recent range and may bounce back within the prevailing uptrend. Conversely, during a downtrend, they reverse this approach. They also use the Bollinger Bands to monitor the market's volatility. The wider the gap between the upper and lower bands, the stronger the volatility. Tighter bands most of the time indicate that the market is in consolidation. Now, let's move on to the next indicator. Number 2, the RSI, or Relative Strength Index, used by Goldman Sachs, a leading global banking, securities, and investment management firm. Paul Tudor Jones, an American billionaire and hedge fund manager of Tudor Investment Corporation, and Citadel Securities, one of the largest market makers in the world, active in more than 50 countries. They use the RSI to identify potential overbought or oversold conditions, RSI divergence to check for potential trend reversals, and to measure the strength and speed of price movements. For those of you who didn't know, the RSI is a momentum oscillator that measures the strength and speed of a price movement, helping traders identify potential trend reversals and overextended market conditions. To use it during an uptrend, wait for the RSI to dip below 30 and then rise back above it, indicating the end of an oversold condition. Conversely, during a downtrend, wait for it to rise above 70 and then come back down the 70 range, indicating the end of an overbought condition. These RSI movements, coupled with the ongoing trend, can signal a potential entry point for a trade. Now, you'll be surprised to learn what and who uses the next indicator. Number 3, the moving average. Used by JP Morgan Chase, a leading global financial services firm with assets worth over $2.6 trillion, and with more than 200 years of history in investing, banking, and financial services operating worldwide. Also used by George Soros, a Hungarian-American billionaire hedge fund manager, and again by Bridgewater Associates, one of the top and largest hedge funds in the world. By using the moving average, they can see a clear visual representation of trends, which smooths out market noise for better direction identification, and use crossovers for entry and exit confluence. For a quick review of what the moving average is, it helps identify trends and potential reversal points by smoothing out price fluctuations over a specified time period. They use moving averages to follow the market's trend. Whenever the price approaches the 20 EMA and 50 EMA, they would expect a rejection and look for an opportunity to buy or sell. The crossing of the 20 EMA and 50 EMA can indicate a possible change in market direction. Number 4. The MACD, Moving Average Convergence Divergence. Known to be used by Charles Schwab Corporation, an American multinational financial services company. Larry Williams, a well-known trader and author of a famous trading book, The Long-Term Secrets to Short-Term Trading, and D.E. Shaw Group, a multinational investment management firm, a company known for developing complicated mathematical models and sophisticated computer programs to exploit anomalies in the financial market. They use the MACD to facilitate the identification of trend direction and shifts to its momentum, generating buy and sell signals through crossovers and divergence with price action. The MACD is a momentum indicator that subtracts the longer-term moving average from the shorter-term moving average, illustrating the momentum of price changes. It typically includes a signal line, an EMA of the MACD line itself, to trigger potential buy or sell signals. Traders look for the MACD line to cross above or below the signal line as an entry signal, indicating increasing upward or downward momentum. Conversely, a cross below the signal line can signal a potential exit opportunity as it suggests slowing momentum. Number 5. Fibonacci retracement. A very controversial indicator, but known to be used by Fidelity Investments, an American multinational financial services corporation. Carolyn Borodin, the founder and president of Synchronicity Market Timing, LLC. She worked on many of the major trading floors in the U.S. and a well-known Fibonacci trading advisor, commodity trading advisor, and technical analyst for more than 20 years. And finally, the BlackRock, the world's largest asset manager, which people called the one who controls the world. They manage over $10 trillion worth of assets, which gives them a very significant amount of power and influence over the global economy. They use Fibonacci to offer insights into potential support and resistance levels based on historical price movements, and assisting them in identifying strategic positions for entries and exits within the context of an existing trend. And for those who don't know, Fibonacci retracement involves drawing horizontal lines at certain percentages of a prior move, commonly 23.6%, 38.2%, 61.8%, and 100%, to identify where prices might potentially reverse or continue. These levels are derived from the Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones. During a trending market, Fibonacci retracement levels can serve as indicators for where to enter the market on pullbacks. They enter a long or short position near a Fibonacci support level, such as the 38.2% or 61.8% retracement levels. And now, here's one mistake traders make that absolutely kills their account. And this is not following or not having a trading plan at all. A trading plan is a comprehensive set of rules and guidelines that outlines a trader's strategy, risk management, and goals, enabling informed decisions in the markets. It encompasses objectives, market selection, entry and exit strategies, risk management, money management guidelines, and processes for performance review. Therefore, not adhering to a trading plan or lacking one entirely can lead to impulsive decisions, inconsistency, and increased susceptibility to market emotions. This is when traders risk excessively, engage in emotional trading, and fail to improve. So, it's crucial to have a trading plan. And with all that, if you enjoyed this video, be sure to subscribe to the channel to learn more about trading, personal finance, and business. Thanks for watching.